We journalize stock investments based on the percent ownership. We have already covered the entries when less than 20% of the company's stock is owned. This was the fair value method, otherwise known as a cost method. In this topic, we will be covering the other methods. We will spend most of the time on the equity method. This is when you own between 20 and 50% of the company's stock. Even though you do not have controlling interest, you own enough to have significant influence over the company. We will learn these journal entries on the next slide. The final category is when you own more than 50% of a company's stock. This is when you do have controlling interest and you essentially own them. In this case, you will prepare consolidated financial statements. As mentioned earlier, we are not going to be preparing consolidated financials since this is an advanced accounting topic. However, I will briefly go over some terms and definitions. Let's begin by looking at the journal entries under the equity method. Remember, the equity method is used for stock ownership of 20% to 50%. The first step is to add the investment to our books, similar to the fair value method. Instead of using the account stock investments, we use the account equity method investments. This is an asset account. We credit cash because no matter the method, we are still spending cash to purchase these investments. The next part is where it gets a little tricky. We're going to account for any dividends received a little differently than under the fair value method. When our investment pays us dividends, we do record this as cash. However, the credit is not dividend revenue. Instead, we credit the equity method investment account. We are essentially lowering the value of our investment. I want to use an analogy that may help explain why we do this. Let's say you have a checking account and a savings account. Both accounts are yours. If you transfer money from your savings account to your checking account, then your checking account received money and the value of your savings account decreased. Since you own this other company, which is your investment, and your investment gives you money, then you did receive money. However, your investment just spent the money, which means it went down in value, like the savings account. Now, the amount for this entry is only the amount that we are receiving in dividends, not the total dividends you are paying out to everyone. It's only your share or your percentage. For example, if I owned 30% of a company, I will use the amount for 30% of the dividends they are paying out, my share only. The next entry is to record our share of earnings. When the investee reports its earnings, the investor, which is us, records our share in our investment account. For this entry, we're debiting equity method investments and crediting earnings from equity method investments. Using the checking and savings account analogy again, let's say your paycheck got direct deposited into your savings account. Well, didn't you just earn money? Didn't the value of your accounts go up? Yes. Even though your income was put into your savings and not your checking account, your income still increased because you own that. Same thing here. Your investment earned income, you will account for your share of that.